There is an insurance company in California with no logo, no agents, and nobody who ever chose it. Last year, it took more than $4 billion in fire claims.
It ran short of money, so it sent a $1 billion bill to every other insurance company in the state.
And then half of that bill got quietly forwarded to ordinary policyholders, people who never bought a thing from it. In 6 years, it went from 124,000 homes to more than 660,000. Let's go find out who is actually standing behind it. In January of 2025, 2 fires tore through Los Angeles, the Palisades, Eaton, and when the smoke cleared, one insurance company was staring at more than $4 billion in claims. But this company has no headquarters you would recognize, no logo on a stadium. Not a single agent anywhere trying to sell you a policy. It is the insurer nobody chooses. The one you land on only after everyone else has said no.
Hold on. An insurance company that doesn't want customers? That sounds backwards.
It is called the California Fair Plan, the insurer of last resort, and in 2025 it did something it had not done in about 30 years. It ran short of money, and it sent a $1 billion bill to every other insurance company in the state. Today, what a last resort actually is, how it is funded, and what happens when the last resort itself starts running dry. By the end of this, you will know exactly whose money is standing behind that policy. And it is almost certainly yours.
So where does a company like this even come from? Somebody had to sit down and build a last resort.
The government did, more or less, and not for fire. Go back to 1968. American cities were burning in civil unrest, and private insurers had quietly pulled out of whole neighborhoods they judged too risky. So Washington made a deal with the states. Set up a pool that has to offer basic coverage to anyone shut out of the normal market, and we will backstop you. Those pools got a name that tells you the whole mission. Fair access to insurance requirements. FAIR. California built its version that same year, a floor under the market, a pool that is not allowed to say no. For decades it stayed small and boring, exactly as intended. Then the Wildfire era arrived, and the thing built for riot-prone city blocks became the default fire insurer for the most flammable hillsides in the country.
And that is where episode 1 comes back in, isn't it? The carriers leaving California.
That is exactly the cause. When insurers can't price wildfire risk the way they want, they stop writing policies, and the non-renewal letters go out by the tens of thousands. Every one of those homeowners has to land somewhere. They land here. Look at the numbers. In 2019, the FAIR Plan covered around 124,000 properties. By the end of 2025, more than 660,000. The value of everything it insures, its exposure, went from roughly $50 billion to over $700 billion in a handful of years. The last resort quietly became a whole lot of people's only resort.
50 billion to 700 billion. That is not a safety net filling up. That is the whole market sliding onto one table and hoping it holds. But okay, I still don't understand what it actually is. Who owns it? When it pays a claim, whose money is that? Where does it physically come from?
Here is the twist that makes the whole thing click. The FAIR Plan is not a company in the normal sense. It has no outside shareholders. It is a pool, a syndicate, made up of every single insurance company licensed to sell property insurance in California. State Farm, Farmers, Allstate, all of them, whether they like it or not. If you want to sell home insurance in this state, you are automatically a member of the last resort.
Wait. So the same companies that stopped writing policies still own the thing that has to pick up the people they dropped?
They do, and they own it by market share. Write 10% of the property insurance in California, and you own 10% of the FAIR Plan, 10% of its profits in a calm year, 10% of its losses in a bad one. Now, in a normal year, the plan pays its claims out of the premiums it collects and the reserves it holds, and it buys reinsurance on top, that same tower of coverage we climbed 2 episodes ago. That is the machine simply working.
And in a bad year?
In a bad year, the premiums and the reserves and the reinsurance are not enough, and this is the mechanism at the heart of today. When the FAIR Plan runs short, it does not go bankrupt. It reaches back into its own members and demands the difference. That demand has a name, an assessment. It is the last resort's emergency cord, and for about 30 years, nobody had to pull it. The plan came close after the big fires of the early 90s, and then it went quiet for a generation.
Until the Los Angeles fires.
Until the Los Angeles fires. On February 11, 2025, the California Insurance Commissioner approved the FAIR Plan's request and pulled the cord. The plan assessed its members $1 billion. The first assessment in about 30 years. And each company's slice was not negotiated. It was set by formula, by that company's market share from 2 years earlier. A carrier holding 4% of the market simply writes a check for roughly $40 million. And to feel how big this cord pull was, look at the last time they yanked it. After the firestorms of the early 90s, the assessments ran to tens of millions of dollars. This one was more than 10 times larger.
So the insurance companies eat it. Good. For once it is not landing on the homeowner.
That is what it looks like. But watch the very last step, because this is where it comes home. Under a rule the commissioner set the same day, a member insurer is allowed to recoup half of what it paid. Not from its investors, from its own policyholders, as a temporary supplemental fee tacked onto your renewal, spread out over the following 2 years. So half of that $1 billion bill flows back out to ordinary Californians, most of whom never bought a FAIR Plan policy in their life. You could be paying down a wildfire loss on a house 300 miles away in a neighborhood you have never seen. Your premium quietly helps fund the last resort, whether or not you ever touch it.
So everybody in the state is basically a cosigner.
Every policyholder in California is a cosigner on the last resort. That is the part almost nobody knows they signed.
But that only works if the members can actually pay. What if one day the bill is not 1 billion, but 10? Can this pool just keep reaching into their pockets forever?
That is the exact question keeping regulators awake. In theory, the members are on the hook. That is what makes the FAIR Plan look bulletproof. In practice, an assessment big enough hits real, admitted insurers who are already retreating from the state, and it lands on their customers too. There is a point where the backstop stops being a backstop and becomes just another cost of doing business in California, passed right down the line to you. Nobody wants to find where that point is. Now step back and look at the trend, because that assessment was not bad luck. It was baked in. Watch the exposure curve. September 2024. The FAIR Plan is carrying about $458 billion of risk. 9 months later, June 2025, roughly $650 billion. By the end of the year, north of $700 billion, with the policy count climbing past 660,000 homes and businesses. Residential exposure alone grew more than 400% in about 5 years. This is not a line that bends. It is a line that launches.
400%. And they are holding what against all of that?
A thin slice, and that is by design. The FAIR Plan was built to be small, a temporary rest stop on the way back to the real market. It keeps modest reserves and leans hard on reinsurance. That design is perfectly fine when it covers 100,000 scattered homes. It is a completely different animal when it has become the single largest fire insurer in the most fire-exposed corner of the country, with hundreds of billions of dollars piled into exactly the zip codes that burn.
So the fire didn't really break the model. The fire just showed everyone the model was already stretched to the edge.
That is it exactly. The Palisades and Eaton claims, more than $4 billion, ran straight past the premiums, past the reserves into the reinsurance, and then into the assessment. And here is the uncomfortable arithmetic of a last resort. The more the private market retreats, the bigger the pool grows. The bigger the pool grows, the more concentrated its risk becomes, and the more likely the next big fire triggers the next assessment. It is a safety net that gets heavier every single time somebody needs it.
Okay, so if I am a homeowner watching this, what am I actually supposed to do with it? And I know this isn't a pitch to buy or dump anything.
No advice, just the machine. Here's what I want you to keep. The insurer of last resort is not some outside charity holding a net under you. It is a mutual promise, an IOU signed by every insurance company in the state, and then half signed again by every one of their customers, which is to say by you. So when you hear the FAIR plan is growing, that is not a distant statistic on somebody else's balance sheet. That is your name being added to a bigger and bigger promise. And the state knows it. That is why the whole push right now is one ugly word: depopulation. Which just means shrink the last resort. Move people back to real insurers through a clearinghouse. Let carriers use catastrophe models to finally price the risk they were running from. Even give the FAIR plan the power to borrow, so a single fire can't force another billion-dollar assessment overnight. Every piece of it is the same one bet: that a last resort only works when almost nobody actually needs it.
And right now, too many people need it.
Right now, far too many people need it, and that in one sentence is the whole story of the last resort running out of room. So keep this: a FAIR plan is not a company, it is all of them, pooled together, with your premium quietly standing behind the promise. It works right up until the market leans on it too hard. And then it turns around and sends the bill back to everyone. I'm Marcus Reeve. I spent 30 years reading the fine print. Every number you just saw came out of the commissioner's own orders and the plan's own filings, and they are all linked below.
And I'm Nora Vance, apparently a co-signer on 660,000 policies I never bought.